Well, hi, and welcome to Market Sense. Market Sense is my new monthly portfolio program where I am here to really share with you the knowledge that I have gained over 48 years of portfolio investing and professional money management. My first career being 34 years as a professional money management expert, and I am so delighted on a monthly basis just to kind of give you a little bit of an overview of what's going on in the markets and some education, not advice, on how you can make better financial decisions and build wealth over time. Well, here it is, the first week in September. And September is historically kind of a slower month. Mostly the markets either go sideways or trend downward over historical times in the month of September. It's a little bit of a slowdown month. And let's talk about why that is. Really, truly, September is a time where the focus shifts to a slower, purposeful contemplation of what the future is going to bring toward the end of the year. Now, we have had a rock and roll August, have we not? It has been up and down and back up again with historic volatility. And really, we've been on our seat. But then suddenly, when the interest rates seem to be settling down by means of an announcement from the recent Federal Reserve Board announcement that are definitely going to be lowering interest rates in a couple of weeks, usually around September 17th or 19th, then the whole market just relaxed. You could feel it in just about every sector of the market. There was a relaxation, a calming, and everybody is ready to go on their Labor Day weekend with a little bit more calmness and fortitude. And now we can look forward to the end of the year and see what's going on there. So let's talk about usually why is September, not just this year, but normally it is a slower month. Mostly it's because historically, this is a time when people are returning back to work after vacation, back to school mentality. And we'll also have companies preparing for their longer term budgets. They might be pulling in some expenses, looking out toward the new year already, looking at the budgets. And then, thirdly, this is a historic month for what we call window dressing. In the stock market, it's called window dressing for a reason, and that means that the portfolio managers of many mutual funds and institutional accounts really take a look at their portfolios and begin to sell off some of the losers and look out into the future to see what better stocks that they can, or bonds, or any other investment that they can shore up their portfolios with. To shore up their portfolios, that means window dressing. And September is a great month when we have a lot of cross currents going on, buying, selling, buying, selling. And so that window dressing really has an opportunity to keep the markets a bit slower. Preparing for the fourth quarter ahead is a mental preparation that portfolio managers go through. Why? Because they want to succeed and make their fourth quarter count. We all want profits, right? We all want to make sure that our fourth quarter counts, especially in the retail industry. The fourth quarter is the one quarter where they really make almost all of their profits for the year. And then, of course, a fifth reason is that we begin to prepare for future volatility ahead. We just take a moment of pause to prepare for the future. And this year, I do believe, as you know, it's going to be a rather uncertain year. It's going to be uncertainty ahead. Why? Because we have the elections coming up. We have lots of problems internationally that are continuing to plague us and worry us. So there's a lot of problems and potential volatility ahead. So this is an opportunity. September is a month to go slower on purpose. Well, I think that what we want to do is take a look at what's going on right now. And that is, so far, so good. It's been a soft landing. We can see these marshmallows here for a reason. It's a softer landing. So far, it looks promising. No recession so far. And it's not only a soft landing, it's perfect to contemplate that in a soft September. Well, one of the things that is contributing to this soft landing, as we mentioned before, are and the announcement by the Federal Reserve that inflation is coming down, interest rates should be coming down in September. We don't know yet. It could be 25 basis points, it could be 50 basis points, but most analysts are calling for at least 25 basis points, maybe 4 times, maybe 2 times between now and the end of the year. Wouldn't it be great if we have at least 1%, one whole percentage, that means 100 basis points by the end of the year? So let's get started. This would be a great time for that to begin to happen, and will continue, if that does happen, to go toward this idea of a softer landing, that the economics can be a little bit easier for all of us. Finally, unemployment remains low, so those worries are not really beginning to really look like it's not as worrisome as potentially before. And of course, the earnings, companies are continuing to report their stronger earnings, and it's been an extremely strong first and second quarter, and this quarter portends to be no different, quite strong for companies. Well, you all know the big watch party of the year has been, no, yes, NVIDIA. It rivals the Olympics, don't you think? How many of you were on your seat waiting for the earnings report to come out last week on NVIDIA, the biggest AI stock in the world, the one company that has the AI chips? And they were beginning to worry Wall Street as to whether or not their earnings were going to keep pace with all of the hype and all of the hoopla that's been going on. And did you know that they even had watch parties where they took over entire bars to watch the earnings announcements coming out from a company? I mean, it rivals the Olympics. It rivals watching football on TV. It rivals watching the US Open right now. My goodness. And what happened? Well, after all of the angst that was building up, thinking that, oh, whatever the future of NVIDIA is, it seems as if that's going to be the future of the entire Standard & Poor's 500, because after all, NVIDIA is one of the largest weighted stocks on that index, the Standard & Poor's 500. And of course, everyone was on bated breath to find out, is AI still alive? Are we now going to see a plunge in the market or a continued move up on strength? That was the pivotal thing that was being bandied about this last week. Well, on the very day that the earnings came out, and of course they were strong earnings, in line, they say, with all of the analyst expectations, but not quite powerful enough to just knock the socks off of everybody as they have been doing in the last 4 quarters. So because it didn't knock the socks off of everybody, the markets trended down, but not by much. It was kind of like, as I mentioned before, a ho-hum event, even maybe a soft landing. And it was funny because we have this saying on Wall Street, buy the rumor, sell the news. And what that means is that everybody gets so excited. They buy on rumors, on the rumors that the earnings or anything is going to be explosive on the upside. And then when the actual thing occurs, most traders sell into it. It's buy the rumor, sell the news. Well, this was kind of like that. Here's a chart of NVIDIA as it relates to its price movement over the last year. And this price movement has been extremely positive all up until this last month, when the NVIDIA stock price not only began to move down, but to worry people as to whether their earnings, and you can see it went up 3 times, testing the top. And we still don't have a resolution as to the next direction of this of the stock price. However, the uptrend is still in place. The market did not sell off large enough to break down the continued upward motion of the momentum of the price action of this company. So far, NVIDIA is on track to continue to lead the market. So that is why we look at charts, to kind of give us an indication of what could be next. But what kind of drama this has been. It's just been so much fun, actually. And so the question is the AI trade still alive? And I would guess, yes, it is. It is still alive. As a matter of fact, it may be the underpinnings for the next bull market ahead, in my opinion. And the only thing that I'd like to add is that I do believe the revenues in their earnings report shows that AI truly is a long game. It's a long-term game. Those revenues have been boosted over the last 5 years for NVIDIA, and it's not going to stop. It might slow down, but NVIDIA itself is being reported to have over 140 billion of revenues in the next year. That is huge. Can any company keep pace with that? Potentially no. But that growth rate over time will slow down. But what if it continues to be very solid and a long-term possibility that spreads out to more and more companies that come on board? This is a very exciting time, and yet it doesn't mean that all companies in this space are going to be benefiting. Let's take a look at one that is suffering right now. And it's in the same industry group, and that would be Intel. How many of you saw Intel making brand new lows in the market on the same week that its competitor, NVIDIA, in the same industry group, chip makers, in the same industry group, NVIDIA making all-time new highs, and Intel, the old solid Intel, making all-time new lows. Look at the chart, absolutely falling off the cliff. This is the top of the cycle for the price movement on Intel, going up, making a high here at $50 a share, a little bit over $50 a share, collapsing down to about the 40 area, collapsing right under 40, down to 30 in a voluminous, quick, fast, falling knife approach, going back just to 35 to kiss it for a second, and then falling again like a falling knife all the way down to 20. That is a 20-year low in the price of Intel, something we haven't seen in Intel for over 20 years. So that means that there is a lot of divergence going on in the market. As investors, we want to make sure that we are in the quality investing companies that are having increasing earnings over time. Intel has had some very difficult problems, as evidenced by their revenues and their earnings. So it's not a surprise that happened overnight. It's been happening and it's been evident over time. So if you know what to watch for, you can find the symptoms and the signals for how the behavior works, and not just for single companies, but also for entire groups of companies, for entire groups of asset classes. That's why I love the market so much. You can actually look at some of the symptoms underneath so that you can get an idea of what's trending and what's next. Because if we can invest in what's next, then we can make some very, very good decisions and build wealth along the way. So here's a good chart, I believe, of what it looks like to go through this economic cycle. And really what we've been experiencing is a normal economic cycle. We have not experienced a major big recession so far, as I mentioned, more like a soft landing, but you're still in the continuation of a longer cycle business trend where it is truly an economic cycle, and of which there are 4 phases. In the first phase, you have the expansion phase, when you have companies, asset classes that outperform the market, including technology. And we certainly have seen an incredible bull market in the technology sector in general, by the AI stocks in specific, in the last 2 to 3 years here. And then in the second phase of an economic cycle is the peak phase. That would be phase 2, where the outperformers in the market in general, these are generalizations, but it's wonderful to be educated about this, are the financials, the energy market industry, and the materials. And we are seeing right now some strength happening in the financials, as well as in the healthcare, in the consumer staple area, and in the utilities. Why would money be going from technology into the safer companies like utilities and consumer staples, financials, and healthcare? It's because during a slowdown or a contraction in the markets, or when worried about whether or not we're going into recession, the companies that do best price wise are the ones that are selling basic services. We all have to pay our utilities, whether or not the markets are up or down. We all have to buy our drugs, especially the aging population. They have no choice. They continue to have to buy their medications. We have to buy food and clothing and so forth, consumer staples. So those are the ones who outperform because they are considered to be safer. And so monies move and rotate from those areas of more volatility into safer areas as the economic cycle trends downward. Well, I'm not saying that we're in recession, but what we do know is that interest rates are going to be starting to come down. There may be a contraction of the economic cycle ahead. We all feel the pressure of prices, inflationary prices, and we know that this is coming. We can feel that this is coming. And of course, there's a lot of unknowns out in the markets. But what happens in phase 3 is that that's really the bottom of that economic cycle, called the trough. And then we start over again. We move into phase 4, where the cycle goes over again. And once that trough happens, we begin to look for new opportunities for the next bull market cycle. And at this time, you want to make sure that you have plenty of cash on the sideline, that you can take advantage of the dip in prices, because prices generally come down over time when the markets contract in a normal phase of the economic cycle. Rather simple, rather exciting, because it means that we can anticipate this, uh, make decisions based on that, but particularly make sure that we have cash on the sideline ready for new opportunities in the future. That's coming. Now, the market sense is one thing, but money sense is what we really want to focus on. And how you are actually allocating your money and making sure that you are having your money invested correctly is the most important thing. Whether we're in a bull market or a bear market, it's what you do with your money that makes the most sense, because in the long run, it's going to be up to you, the decisions that you make that will help you build wealth over time. So we want to make sure that we build in a lot of money sense, what I call money sense, not just have the market, the understanding of what the markets are doing, but how does that translate into the daily decisions that we make about our own money, how to save it, how to invest it, how to multiply it, how to maximize it so that we have plenty to retire on, and have plenty wealth building, I call it, to do all of the things that our heart's desires. Would you be up for that? Yes, I know. So here we are in an era of learning better tools on how to become investment managers ourselves. I do believe that inside all of us is an ace money manager just waiting to be empowered so that we can take control of our own destiny financially. Whether or not we have outside money managers working on our behalf, it is still up to us. The buck stops here. The monies that we earn over time are ours. So we want to make good sense, good judgment. So going forward, I want to just mention to you all that you are invited to take my 2-minute financial IQ quiz. Very, very simple. It'll kind of give you a taste or an idea of where you are now. You know, what is the sense that you make about your money now? How are you, um, what is your IQ about money now? And how is it going for you? And is it a possibility that you have been able to make some good decisions on your own? These kinds of things, we can easily determine where you are now. And it doesn't matter whether you're a beginning investor or a medium kind of an investor, or someone who's been in the markets for years and years and years and a seasoned investor. Wherever you are now, we can always get better. So this is kind of a fun 2-minute financial IQ quiz. I invite you to go to, if you're interested, go to lynnekitchen.com. You can take that quiz, and what you will receive is absolutely a personalized review back to you from me. So I will be looking at it personally and giving you a personal review back. If that is something that you would love, I invite you to, as I mentioned, go to lynnekitchen.com and just click there to take the financial IQ quiz. It's a lot of fun, and you'll learn more about yourself. Now, in conclusion, I just want to talk about where I believe we are, just to summarize how we need to view the last quarter as we move into September, getting ready for the final push into the last part of the year. So this is very important for us to take the time now to look at our portfolios, to look at all of the assets that we do have. Look at the debts that we have, look at the assets we have, look at the progress that we've made so far this year. Give ourselves some credit for that. And then let's take a look at where we're wanting to go and be by the end of the year. So here is what I truly want to say, that we want to go back to basics. September's a great time, back to school, back to basics. What are the basics? The basics are investing can be fun, profitable, lucrative, and life changing if we master a few basic principles of investing. And that would include making sure that you have an asset allocation or a mix that is in your best interest. And I'm just going to say, what's back in style right now is the old fashioned, back to basics 60-40 mix. What that means is 60% in equities, 40% in bonds or fixed income. And that has been a formula for success over time, which allows enough diversification and enough growth so that you actually can create lasting wealth over time, withstand some of the shocks in the market, and still have enough growth to last. This was out of favor for several years when the interest rates were not cooperating with us, so bonds was not a place to be. But now, bonds and the fixed income part of your asset allocation is back in style. So this is actually going to be a very, very back to basics style that if you don't have that in place, it might be something for you to look at, because it definitely probably will be a very good asset allocation for you going forward, especially in the next 5 years. Okay, and then secondly, solid long-term plan. Let's make sure you've got a plan. How many of you don't have any plan? Listen, many people don't even have a plan for their money, although they have plans for their vacation, plans for the next big corporation or big idea that they're going to do, plan for their business, but they don't have a personal plan for themselves. So it's very, very important that you have a plan, and a long-term plan, so that we can actually see out into the future and make sure that you are well invested and back to the basics. Well, that would also include an analysis on what you own. Do you understand what you own? Do you understand the investments that you own? And this is an opportunity in September. Let's make sure we take the time, slow down on purpose, to look at our holdings, to make sure that we understand the quality, quality, quality lasts for the long run. Quality is what we want to own. And this is the month to get rid of the junk. This is the month. Those investments that have not been doing well, those investments that are lower than quality, and you can learn what quality is. You can ask me. I have investment classes that teach that. So it's going to be a lot of fun for you to make sure that you're in quality, quality, quality. This is the month. Get ready for the future by making sure you are in quality and that you understand what you own. And then finally, add some hedging in there. This world is so unpredictable that we want to make sure that you have higher diversification at this time. So now more than ever, in addition to the old-fashioned back to basics 60-40 mix, I would say, in my opinion as a portfolio manager, now more than ever, it's important to add in a commodity such as gold to hedge against inflation, to hedge against the possibility that the price of our dollar might be diminishing over time. The strength of our dollar looks pretty toppy right now, and it also looks like over time, we might be in a total different de-dollarization trend internationally. These are times in which gold does best. Gold actually does best also in times of lower interest rates. So as interest rates are beginning to now come down from short-term historic rates, levels, I mean, this would be an opportunity to take a look at adding in something like a commodity like gold or silver. And of course, once again, this is for educational purposes only. And I'm talking in broad generalization terms. You as an individual are unique and your risk tolerances are unique. So it's important for you to make sure that you make the decision based upon your own needs and where you are in the markets and where you are in life, in the life cycle that you have. So that would be important. And then also the cash reserves on the sideline, ready to go back into the market if we do have a volatile market and potential prices coming down, so that things are on sale. That's the time, is it not? We want to buy when things are on sale. The old idea of buy low, sell high. Well, you can't sell high profitably if you haven't purchased low. So the opportunities to buy low come around, but we have to have the cash on the sideline ready for it. That's what we need as the final idea here, is to make sure that you understand what you are invested in, that you have a diversification, that you add in additional diversification, and that you have adequate cash in reserve. And if you do that now in September, you are going to be well ready for the volatility that we have in store for us in the fourth quarter of this year with the elections and so forth. And you're also going to be ready for potentially making this year your very, very best, most profitable year in the stock market, or I certainly wish that for you. And so with that, I will leave you for today, and I wish all the best to all of you. Thank you. It's been a pleasure. Bye for now.